Today's topic is accounting for joint arrangements. These sorts of arrangements represent a middle tier between significant influence and control. Joint arrangements arise when more than one party shares control of the business interest. Joint control is typically established by way of a contractual agreement between all of the parties to the joint arrangement. The contract might be a shareholders agreement that precludes one party from exercising control regardless of their ownership entitlement. A joint operation arises when each venturer contributes the use of an asset or other resource to the joint operation, but the venturer maintains title and control of the assets and resources allocated to the joint operation. There is no separate entity per se, just an agreement between the venturers to jointly pursue a business activity and act as one. So what do we need to keep in mind when accounting for a joint operation? Well, each venturer tracks their own assets and liabilities, as well as the expenses they incur on their own behalf. However, it shares in the revenue and expenses from the business activities of the joint arrangement. So for example, if parent corporation is a fishing company and supplies the fish to the joint operation, and joint corporation owns the fish processing plant that turns the fish into, say, fish sticks, both venturers will track their own assets and costs and liabilities as they pertain to, say, the fishing vessels and the fish plant. However, they will only recognize the revenue and manufacturing costs of sales associated with the processed fish once it's sold to an external customer. Another type of joint operation could be a situation where both parent corporation and joint corporation agree to buy an asset and jointly own and operate it together. In this case, let's assume the parent corporation and joint corporation agreed to buy a power plant. Each venturer would pick up their proportionate interest of the business on a line-by-line basis and report those results within their own. This is called proportionate consolidation, which is akin to the proprietary theory of consolidation. That is where the parent simply picks up its entitlement and does not record a non-controlling interest for the joint corporation's ownership stake. Now, there's one more wrinkle to consider, and that happens when a venturer contributes or sells an asset to the joint operation. And since there's an element of funny money, and by that I mean you're selling a portion of the asset to yourself, you can't recognize the entire gain or loss. Note that if a loss is incurred at the date of transfer of the asset to the joint operation, and that loss is determined to represent an impairment of the asset, well then the entire loss gets recognized immediately, and we don't have any of this contra account phenomena to worry about. Let's look at a specific example, such as the one that's presented on the screen in front of you. Here we have parent corporation transferring a building to a joint operation. Keep in mind that in this case it has a 40% interest in the joint operation. The gain on the disposal is $30,000. The joint operation has a joint asset of $100,000, and proportionately speaking, $40,000 finds its way back to parent corporation, along with 40% of the depreciation. And then things start getting interesting. Parent corporation can only recognize the gain to the extent of joint corporation's interest. That is the 60%. So $18,000 becomes a realized gain. The other $12,000 is set up as a contra account against the building account and is amortized against depreciation over the remaining life of the building. Et voila! It's something similar to what we saw when we had a depreciable asset that was sold between affiliated companies. Let's look at this second type of joint arrangement, and this is called a joint venture. And a joint venture arises when a venturer has a right to only a share of the outcome generated by a separate entity. The separate entity can take either an incorporated or unincorporated form, such as a partnership. Under IFRS 10, the venturer must use the equity method to report its investment in the joint venture. Now, we are very familiar by now with what the equity method is. And believe me, it's better than using proportionate consolidation, which has been allowed in the past and may still be available under alternative gaps. So, just like we would account for the significant influence investments, we must consider all the same things, only with a few slight variations. We still must allocate and amortize an acquisition differential. We still must eliminate unrealized profits on intercompany transactions, and we still must account for any contributions to the joint venture. So let's now discuss the nuances. Upon the formation of a joint venture, there is no acquisition differential per se. The venturers themselves are the original founding shareholders. However, if a venturer purchases their interest from another venturer, then once again we're going to have a purchase price differential, which would be dealt with along the same lines as we've discussed in previous lessons. Secondly, where in the consolidation accounting we eliminate 100% of the profits on intercompany transactions, in this situation we don't. Similar to the methodology we just discussed with a joint operation, we can realize the profits to the extent of the other venturer's interests. Only the profits generated from selling to ourselves needs to be deferred until the transaction ultimately occurs with a third party. However, the same deal for losses of a permanent nature applies. No deferral for those. Finally, we have the contributions to the joint venture. And once again, these work in the same way as we just saw in our previous example with the building. Only the gain represented by the interest of the non-related venturers should be recognized on the date of the contribution. The portion of the gain representing the venturer's own interest remains unrealized until the asset is sold outside of the joint venture or as the asset is consumed by the joint venture itself. These unrealized gains are set up as a contra account to the investment account this time and not the specific asset account on the balance sheet of parent corporation. To make matters just a little more complicated, the amount of the realized and unrealized gain can also be adjusted when parent corporation receives cash back in addition to their interest in the joint venture. Now, we will assume that the benefit and the risks of ownership were transferred along with the asset to the joint venture. This allows the recognition of the gain. Now, note because the cash originated from the other venturer, in this case joint corporation, that the cash portion of the gains are deemed realized, the $420,000. The unrealized portion, the $280,000, would be realized over the life of the asset along the lines just discussed and would be set up as a contra account against the investment account. Let's pile on to this example, only this time assume that there was no transfer of the benefits and risks upon the initial contribution of the plant to the joint venture by parent corporation. And at the same time, let's continue assuming that $450,000 was taken back by parent corporation in cash. Only this time the cash originated from debt financing raised with a lender. Now this is what I call really hard accounting. Because the benefits and the risks have not transferred, the whole $700,000 gains is unrealized. However, we can still break the gain into two components. $280,000 gets set up as a contra account against the investment account, and this portion of the gain will be brought into income over the life of the plant. The second portion of the gain relates to the unrelated venturer's portion. Now, we can't recognize this portion until proceeds are received. And in this case, we have received $450,000 of funds raised from the issuance of debt in the joint venture. These funds are apportioned between the two venturers based on their entitlement split, which results in $270,000 of debt proceeds being attributed to joint corporation. And for recognition purposes, this enables a partial realization of the deferred gain. We must prorate the carry value to determine the amount of the gain to recognize, which turns out to be $189,000 at the date of transfer. The remaining $231,000 would be set up as a liability and awaiting the receipt of further proceeds or the sale of the asset outside of the joint venture itself. So don't ask me to explain that again, and I would hardly expect anyone to remember all this stuff. If you find yourself in a situation such as this, well, at least you now have a resource to go to. I think I dug us into a deep enough hole for this lesson, so until next time, don't stop to get to the top. When you get to the top, don't stop.